that we will in silver retest 35. And I believe at some point next year go as high as $40 to $42. I would like to say 50, but my technical studies indicate that we first have to hit that milestone first. In regards to gold, we know where absolute resistance is. It's the recent all-time record high at 2,800. In terms of support, there was, I should say, the potential for support at 2,600. However, it's broken through there, and I believe the 61.8% Fibonacci retracement of the entirety of this rally, which is about 2,300 to 2,800.
Silver has marked a significant milestone in recent market activity, breaking above $34 per ounce and reaching $35, a level not seen in over a decade. GaryWagner, a technical analyst specializing in gold and precious metals markets, anticipates a correction, but expects silver to retest the $35 level. His analysis suggests potential upward movement to $42 to $44 in the coming year, though he cautions that reaching the $50 mark would require establishing these intermediate levels first. Market forecasters remain optimistic about the near-term prospects, projecting a solid start to the year, with silver potentially opening at $38.77 and reaching as high as $40.71 in January. The market is expected to experience fluctuations throughout the year, with analysts predicting a low point of $32.77 in October before rebounding to approximately $38.30 by year-end. Looking toward the future, analysts present varying long-term projections. For 2026, most experts forecast silver to trade between $33 and $44 per troy ounce, though some more bullish analysts suggest potential prices between $63 and $68. The outlook for 2027 to 2035 appears more conservative, with predictions generally falling within a $33 to $40 range, reflecting a more measured view of silver's long-term prospects in the precious metals market. The historical relationship between silver and gold provides an exciting context for market dynamics. Wagner points out that while silver has typically lagged behind gold, 2011 proved to be a remarkable year for both precious metals. Silver demonstrated unusual market behavior by reaching its peak of $50 an ounce in mid-2011, notably 5 months before gold's historic high. This pattern was particularly noteworthy as it deviated from the traditional expectation of silver following gold's lead. When gold eventually reached its record high of over $1,900 per ounce in September 2011, both metals benefited from investors seeking safe havens during the global financial crisis. Before we start, please remember to subscribe and hit the bell icon to stay updated. Please also share this video with friends who might find it useful.
Silver really dogged behind gold for years. If you consider that, let's go back to 2011, midpoint of 2011, gold runs up to the new all-time record high above 1,900, seems tepid right now. Silver runs to $50 an ounce. We then have a multi-year correction from 2012 to 2016, and at that point there was a pivot or a switch from a market sentiment which was remarkably bearish to one that was regaining bullish momentum. When we saw gold and silver move up, they moved up in tandem, but there was a disconnect because whereas this year and to some degree last year, we saw gold trade to multiple all-time record highs, silver lagged behind gold. However, what we recently saw in silver before the correction began, which occurred very recently, was $35 an ounce silver. And while that might not sound like a magnificent milestone, considering it is the first time we have seen silver breach $34, in 12 or 13 years. And so in terms of what I'm looking at, remainder of this year, say first and second quarter of next year, is once the correction concludes, and I think we might be close, but I could be wrong, but I do know in my heart that Paul Volcker, one of the Federal Reserve heads, used to say in relationship to the dollar, trees don't grow to the sky, they never have, they never will. In other words, there is a ceiling and there is a level of support that's absolute. And so what I mean by that is at some point both gold and silver will cease to correct. And at that point, we'll enter another momentum of a bullish price advance. And whatever level that's at, I think that we will, in silver, retest 35. And I believe at some point next year go as high as $40 to $42. I would like to say 50, but my technical studies indicate that we first have to hit that milestone first. In regards to gold, we know where absolute resistance is. It's the recent all-time record high at 2,800. In terms of support, there was, I should say, the potential for support at 2,600. However, it's broken through there, and I believe the 61.8% Fibonacci retracement of the entirety of this rally, which is about 2,300 to 2,800. If you take the 61.8% retracement, it comes in at around 25. And I think that that's an area where gold really should find support if it hasn't already. So that's my take in terms of gold and silver. I'm exceedingly bullish next year. I need confirmation that this current correction has run its course. But irregardless, at some point, the correction will conclude. And following that, our technical studies, as well as the fundamental fabric that have moved these precious metals off of the recent lows, will reemerge. And the prices we're looking at now, what you can pay for if they go to silver bullion, is going to look great. Whether it's 2 months or 4 months from now, the prices now might be a real good buy or a bargain, let's say.
Gary Wagner's analysis of the Federal Reserve's interest rate cuts aligns with the recent movement in gold prices. While the Fed's rate cuts typically boost gold, helping it rise, the U.S. dollar has continued outperforming other currencies in its basket, demonstrating its strength. Despite the dollar's resilience, gold prices still experienced a notable rise. Spot gold increased by 1.2%, reaching $2,691.36 per ounce after hitting a 3-week low earlier. U.S. gold futures also gained, rising 1.1% to close at $2,705.80. This price movement highlights the complex interplay between the Fed's policy and the market's reaction, where gold prices benefited from a slight retreat in the dollar, even as the dollar remained strong overall. Wagner notes that gold peaked at $2,800, driven by a strong U.S. dollar, an uncommon scenario in which both rose together. The pullback followed the resolution of election-related uncertainties that had previously boosted gold. Despite the pullback, gold demand remained strong due to safe haven buying, fueled by geopolitical tensions and election uncertainty. These factors suggest gold will continue to act as a store of value, supporting upward price pressure as investors seek stability. Let's get back to the interview.
What we are seeing right now is realize that central bank accumulation occurred brisker, aggressively throughout last year. And last year we saw gold run at the beginning of the year, I believe, at around 2,000 up to 2,800. The fact that it hit multiple all-time record highs would lessen the appeal of accumulation by central banks in terms of the quantity, the viability, and at what levels they would accumulate. A central bank realizes that there is intrinsic value in the precious metals, to a lesser extent silver, although they're not accumulating it because you can't store as much in terms of weight and price per ounce. Precious metals have held intrinsic value, continue to, and in my opinion, will always have that intrinsic value. And what I mean to say is, although we'll see variation in the price of gold and silver, to a lesser extent platinum or palladium, gold and silver will always have a unique demand due to the fact that all currencies are fiat, and the only real asset that has intrinsic value that by definition cannot dissipate. You can't print more gold, you can't print more silver. And so for that reason, those precious metals are going to hold those values. They will vary in value, but they're not going to diminish, meaning we'll see both gold and silver vary in price, but always hold definitive intrinsic value. We saw gold run to a high of 2,800 and then pull back. The reasons I believe it's pulled back are the first 2 points you mentioned, and I'll elaborate in a second, and thirdly, dollar strength. Interestingly enough, during the run-up, both the dollar and gold were moving higher in tandem, a rare occurrence. But specifically with gold, a lot of that baked-in premium was in regards to the presidential election outcome. And what I mean by that is the key was whether or not there would be a decisive winner and whether or not the candidate that lost would contest the election. Trump won. Obviously, the other side didn't contest it. In other words, a peaceful transfer of power. So what we witnessed right after the election and a little bit before was the premium of uncertainty about the election outcome in the United States, because it has such a huge global impact, virtually erode over since the election itself, which was less than 2 weeks ago. So we've seen gold come down from about 2,800. It's now below 2,600. And that is a combination of dollar strength and that uncertainty factor of the outcome of the election coming out of the premium for gold. As the Federal Reserve has begun its interest rate normalization and they cut rates, while on the surface, lower interest rates are beneficial for gold, but not beneficial for the dollar continues to outperform the currency basket that it is weighted against. So the best explanation is, regardless of the narrative, the dollar remains strong because traders, institutions, central banks are accumulating a couple of things: dollars, US, and gold. Central banks have been purchasing gold for the last year at a rate that's unheard of. Now the emerging market countries are getting involved. China paused, but I believe that they're back into gold accumulation. When we look at the relative costs of whether it's silver, gold, relative cost or value of a currency, the values speak for themselves. Any explanation I present or anyone else is really irrelevant. If the fundamentals that have moved the dollar substantially higher, up 6% in a short period of time, as long as they remain, we are going to see dollar strength.
Gold and silver have experienced significant price fluctuations, driven by economic factors such as interest rate changes and market demand. Gold has remained strong, bolstered by global economic uncertainty and continued accumulation by central banks, despite lower interest rates. While traditionally lagging behind gold, silver has demonstrated resilience, hitting key milestones and reflecting growing investor confidence in precious metals as a hedge against economic instability. Are you following the latest trends in gold and silver? Share your thoughts in the comments below. If you found this video helpful, like, subscribe, and hit the notification bell for updates. Thanks for watching, and see you in the following video.